For most people, liquidity is something you either have or lose. It is present in good times, and it disappears in bad ones. That is the common belief. But liquidity does not work that way. It does not vanish. It relocates. And the most dangerous periods in financial history were not defined by a lack of liquidity, but by liquidity being in the wrong hands, in the wrong places, at the wrong time. Right now, many investors believe liquidity is gone. Markets feel thinner. Volatility feels unpredictable. Rallies feel fragile. Confidence feels artificial. So the conclusion seems obvious. Liquidity must have dried up. But that conclusion is wrong. Liquidity is still there. It is just no longer where people expect it to be. And that change explains almost everything we are seeing. For more than a decade, the global financial system operated under a single assumption, that liquidity would always be accessible, not necessarily cheap, but available. Central banks expanded. Balance sheets, interest rates stayed suppressed. Funding costs remained manageable. This created a predictable environment. Risk assets thrived. Leverage expanded. Complex strategies flourished. Liquidity was not questioned. It was assumed. And when something is assumed long enough, it becomes invisible. People stop thinking about where liquidity comes from, who controls it, and under what conditions it can disappear or move. That complacency is what made the current shift so destabilizing, because nothing actually broke. Liquidity was not destroyed. It was redirected, and redirection is harder to recognize than collapse. When liquidity disappears, markets crash violently. Prices gap down. Volatility explodes. Everyone sees the problem. But when liquidity shifts, markets behave strangely. Prices drift instead of collapse. Spreads widen quietly. Certain assets stop responding to good news. This creates confusion. Participants feel something is wrong, but they cannot point to a single cause. That confusion is not accidental. It is the natural result of liquidity becoming selective. In the past, liquidity flowed broadly. It supported equities, credit, real estate, growth assets, speculative assets, all at once. Today, liquidity still exists, but it flows narrowly. It favors safety over risk, cash over leverage, short duration over long duration, balance sheet strength over growth narratives. This changes market behavior fundamentally. Assets do not collapse together. They decay at different speeds. Some appear stable, others weaken quietly. A few even rise, creating false confidence. This is how misinterpretation begins. People see markets holding up and assume resilience. But resilience is not stability. It is resistance. And resistance only lasts as long as pressure remains tolerable. Another critical misunderstanding is who controls liquidity. Most people think central banks are the sole source. They are not. Banks create liquidity through lending. Funds create liquidity through leverage. Markets create liquidity through confidence. All three have changed. Banks are more constrained. Funds are more cautious. Confidence is conditional. So while headline liquidity measures may appear stable, functional liquidity is shrinking. Functional liquidity is the ability to transact without moving prices, and that ability has deteriorated. This is why markets feel brittle, not because there is no money, but because fewer participants are willing to deploy it aggressively. Capital has become defensive, and defensive capital behaves very differently from expansionary capital. Expansionary capital chases returns. Defensive capital protects optionality. When capital protects optionality, it waits. It sits in cash. It sits in short-term instruments. It sits on the sidelines. From the outside, this looks like liquidity disappearing. In reality, it is liquidity refusing to participate. And that refusal creates pressure, because modern markets are built on participation. Prices assume constant engagement. Valuations assume ongoing inflows. Stability assumes willingness to absorb risk. When that willingness fades, markets must adjust. Not suddenly, not dramatically, but persistently. This is the environment we are in now. Liquidity has not left the system. It has moved to places where it feels safe, and that movement creates imbalance. Assets that depended on continuous inflows are exposed. Strategies that relied on stable correlations become unstable. Assumptions built on abundance start to fail. This is not a crisis phase. It is a transition phase, and transition phases are where the most damage is done, because they lull participants into thinking nothing is wrong, until the system reaches a point where adjustment can no longer remain orderly. In the next parts, we will examine where liquidity has actually moved, why this shift is accelerating, and which parts of the system are most vulnerable to being left behind. If liquidity did not disappear, the obvious question is simple. Where did it go? The answer is uncomfortable because it contradicts how most people think about markets. Liquidity did not move outward. It moved inward, away from risk, away from duration, away from uncertainty, and toward control. To understand this shift, we need to stop thinking about liquidity as money. Liquidity is not cash. Liquidity is not balance sheets. Liquidity is behavior. It is the willingness to deploy capital without demanding immediate compensation for risk. For years, that willingness was abundant. Low rates reduced the cost of mistakes. Central bank intervention reduced downside fear. Volatility suppression reduced perceived risk. Under those conditions, liquidity spread everywhere. But when conditions change, behavior changes first. Not prices, not headlines. Behavior, and behavior changed quietly. The first place liquidity moved was duration. Long duration assets are the most sensitive to changes in rates, inflation, and policy credibility. When rates were anchored near zero, duration was a gift. When rates rose, duration became a liability. So capital shortened its time horizon. Long bonds lost appeal. Growth assets lost support. Future heavy valuations became fragile. Liquidity moved into short-term instruments. Treasury bills, money market funds, cash equivalents. These are not panic moves. They are rational adjustments. But collectively, they drain liquidity from risk assets. The second place liquidity moved was leverage. Leverage amplifies returns, but it also amplifies uncertainty. When funding costs were low and predictable, leverage was safe. When funding costs rose and became volatile, leverage became dangerous. So leverage was reduced, not eliminated, reduced. Hedge funds cut gross exposure. Banks tightened lending standards. Private credit became more selective. This does not show up as a crash. It shows up as thinner markets, fewer bids, wider spreads, more price sensitivity. Liquidity still exists, but it demands better terms. The third place liquidity moved was complexity. Complex strategies rely on stable correlations. They assume relationships hold. They assume stress is temporary. But when the system enters adjustment, correlations change. Assets that used to hedge each other stop doing so. Volatility spikes where it is least expected. Models fail quietly, so capital simplified. It moved into transparent exposures, direct holdings, instruments with predictable cash flows. Complexity became a risk premium instead of a return enhancer. This further concentrates liquidity. Instead of flowing broadly, it clusters. Certain assets receive overwhelming demand. Others are ignored completely. This creates a misleading picture. Some markets appear healthy. Others deteriorate quietly. Observers focus on what is rising and assume stability. They ignore what is no longer trading. The most important shift, however, is psychological. Liquidity moved from confidence to caution. For years, investors believed someone else would always step in, a central bank, a government, a larger buyer. That belief created a safety net. But today that net feels thinner. Policy is constrained, debt levels are high, inflation limits intervention. So liquidity waits for confirmation instead of anticipating outcomes. This waiting behavior slows markets. It reduces momentum. It increases sensitivity to negative surprises, and it creates a paradox. Everyone waits for clarity, but clarity never arrives without participation. This is why markets feel stuck, not collapsing, not recovering, drifting. Liquidity has positioned itself defensively, and defensive liquidity does not support valuations. It protects itself. Another critical area where liquidity moved is geography. Capital has become more selective, not just by asset class, but by region. Countries with stable funding structures retain liquidity. Those dependent on external financing lose it. This creates uneven stress. Some economies tighten quietly, others appear insulated, but the system is interconnected. Stress does not stay contained. It migrates, just like liquidity. What makes this phase dangerous is that none of this feels extreme. There is no singular shock, no dramatic headline, no obvious villain, just persistent pressure. Markets adjust slowly. Participants rationalize. Risk is tolerated longer than it should be, because nothing forces immediate change. This is how systems stretch, and stretched systems do not break at the weakest point. They break at the most rigid one. Liquidity is testing rigidity right now. Where assumptions cannot adapt, stress accumulates, and accumulated stress does not resolve gently. In the next part, we will examine why this shift in liquidity is accelerating, not stabilizing, and why the longer it continues, the more disruptive the eventual outcome becomes. At first glance, the movement of liquidity we just described looks stabilizing. Less leverage, shorter duration, more caution. That sounds healthy, but stability created by retreat is not the same as stability created by balance. And this distinction matters, because when liquidity concentrates instead of circulating, the system becomes brittle. Liquidity is supposed to absorb shocks. It smooths transitions. It allows markets to reprice gradually. But when liquidity clusters, it stops playing that role. It becomes selective, conditional, fragile. The first source of instability comes from asymmetry. When liquidity concentrates, some assets become oversupported, others are left exposed. This creates false signals. Indexes may appear stable or even rising, but beneath the surface, participation is narrow. A small number of assets carry the market. The rest lag, weaken, or lose depth. This is not resilience, it is imbalance. And imbalances amplify small disturbances. A minor shift in sentiment, a modest policy surprise, a routine data release. Under normal conditions, these would be absorbed. Under concentrated liquidity, they propagate because there are fewer marginal buyers, fewer buffers, less redundancy. Another destabilizing effect is time compression. When liquidity is cautious, it delays decisions. Positions are maintained longer than optimal. Risk is tolerated quietly. But once adjustment becomes unavoidable, it happens quickly. What did not move for months moves in days. This creates the illusion of sudden collapse. In reality, the system was stretched the entire time. The adjustment only becomes visible at the end. This is why many market breaks feel abrupt, even though they were years in the making. The third source of instability is pricing distortion. When liquidity is abundant, prices reflect consensus. When liquidity is selective, prices reflect positioning. That difference is critical. Consensus pricing incorporates diverse views. Positioning pricing reflects who is still willing to act. This makes markets less informative. Prices stop signaling underlying risk accurately. They signal where liquidity still exists. Observers mistake this for strength. They see prices holding and assume stability. They ignore the declining quality of price discovery. This is dangerous, because when prices finally move, they overshoot. There is no gradual adjustment, no orderly repricing, just air pockets. Another destabilizing force is feedback loops. As liquidity withdraws from certain areas, volatility rises. Rising volatility discourages liquidity, which further increases volatility. This loop does not require panic, it requires hesitation. Participants step back, spreads widen, execution becomes costly. This reinforces caution. Over time, entire segments of the market become illiquid without collapsing. This is what makes the current environment so deceptive. Nothing is breaking, but everything is less flexible. Flexibility is what prevents crises, not optimism, not confidence, flexibility. And flexibility has been reduced systematically. One of the most misunderstood elements of this phase is the role of policy. Many assume central banks can restore liquidity at will. But liquidity does not respond instantly to policy signals. It responds to credibility. When policy credibility is questioned, intervention loses effectiveness. Liquidity becomes skeptical. It waits to see if policy actions will stick, if inflation will respond, if political pressure will interfere. This waiting behavior neutralizes stimulus. Policy can add reserves. It cannot force risk-taking. That distinction is crucial. Liquidity today is not constrained by supply. It is constrained by trust. Trust in stability, trust in rules, trust in predictability. Without trust, liquidity remains defensive. And defensive liquidity amplifies instability because it refuses to absorb risk until risk becomes undeniable. At that point, it is too late to absorb it gently. The final destabilizing element is narrative lag. Most market narratives are backward-looking. They explain what already happened. But during structural shift, narratives lag reality. Participants continue using outdated frameworks. They rely on historical relationships. They assume mean reversion, but the system they are referencing no longer exists. This mismatch creates delayed reaction. When recognition finally occurs, adjustment is compressed. This is why forced adjustments feel unfair. They punish those who were patient. They reward those who exited early without clear justification. But markets do not reward patience. They reward adaptability. Right now, adaptability is limited by belief. Belief that liquidity will return to its previous behavior. Belief that volatility suppression will resume. Belief that intervention will dominate outcomes. These beliefs delay adjustment, and delayed adjustment increases instability. In the next part, we will identify which parts of the system are most exposed to this dynamic, and why stress is building there first, not last. When systems adjust under constraint, stress does not appear everywhere at once. It concentrates, and it concentrates in places that look safe. This is one of the most counterintuitive aspects of the current cycle. Risk does not surface first in the weakest areas. It surfaces where assumptions are most rigid. The first pressure point is duration. For years, long-duration assets benefited from suppressed rates and predictable policy. Cash flows far in the future were discounted generously. Volatility was assumed temporary. Rates were assumed reversible. Those assumptions no longer hold. As liquidity became selective, it shortened its horizon. It moved toward assets with immediate cash flow. It avoided long-term commitments. This creates pressure without collapse. Prices drift. Multiples compress. Liquidity thins. There is no dramatic event, just persistent erosion. This is why many high-quality assets underperform quietly, not because they are broken, but because the environment no longer rewards duration risk. The second pressure point is leverage-dependent stability. Any strategy that relies on rolling funding becomes fragile when liquidity tightens, not because funding disappears, but because its terms change. Margins increase, haircuts rise, tenors shorten. These are small changes, but they compound. Participants adjust by reducing size, reducing activity, reducing risk-taking. This is not forced liquidation. It is voluntary retreat. And voluntary retreat is slower, but more damaging over time, because it reduces market depth without resetting prices. The third pressure point is passive structure. Index-based allocation assumes liquidity is always available. It assumes inflows and outflows can be absorbed smoothly. It assumes diversification across constituents. But when liquidity concentrates, these assumptions break. Flows move prices disproportionately. Correlations rise, diversification weakens. The structure remains intact, but its behavior changes. This creates latent instability. Nothing looks wrong until flows reverse. Then the lack of depth becomes obvious. Another area of pressure is the boundary between public and private markets. Private assets thrived in an environment of abundant liquidity. Valuations rose. Exit options were plentiful. Funding was cheap. As liquidity shifted, exits slowed. Pricing became opaque. Capital became patient, but conditional. This creates valuation lag. Public markets reprice first. Private markets follow later. This lag creates a false sense of stability. Balance sheets appear healthy. NAVs hold. But transaction evidence disappears. When repricing finally occurs, it is abrupt. Not because fundamentals collapse, but because liquidity recognition arrived late. The next pressure point is currency exposure. As liquidity becomes selective, capital favors stability. It moves toward perceived safety. It avoids complexity. This creates uneven currency pressure. Some currencies strengthen without strong growth. Others weaken despite reasonable fundamentals. This is not about trade balances. It is about liquidity preference. And currency moves amplify stress elsewhere. They affect funding costs. They alter competitiveness. They shift capital flows. These effects accumulate quietly. Another overlooked area is collateral quality. When liquidity was abundant, collateral standards were relaxed. Assets were accepted broadly. Haircuts were modest. As liquidity tightens, standards rise. Only the highest quality collateral circulates freely. Everything else becomes conditional. This affects funding chains. Transactions take longer. Costs increase. Flexibility declines. Again, no panic, just friction. Friction is how instability grows without noise. Finally, there is pressure on expectations themselves. Participants anchor to previous cycles. They expect familiar patterns. They wait for familiar signals. But this cycle is defined by constraint, not shock. There may be no single moment of recognition, no dramatic bottom, no clear capitulation. Instead, there is a gradual realization that old behaviors no longer work. This realization is uneven. Some adapt early, most adapt late, many adapt too slowly. This creates divergence. Divergence increases volatility. Volatility discourages liquidity. Liquidity withdrawal increases divergence further. This is the loop. The system is not collapsing. It is shedding assumptions, and assumptions are removed unevenly. That is why stress appears first in places that look stable, places where change was least expected, places where flexibility was optimized away. In the next part, we will explain why this adjustment cannot be reversed, and why attempts to slow it often make the final outcome more abrupt. At this stage of the cycle, many participants still believe the adjustment can be delayed, that policy can soften it, that liquidity can return, that conditions can revert. This belief is understandable. It worked before, but this time the constraints are different. The previous cycle was defined by optionality. This one is defined by limitation. Interest rates are no longer a free variable. They are bounded by inflation. Balance sheets are no longer expandable without consequence. They are constrained by credibility. Liquidity is no longer unconditional. It is priced. These are not choices. They are structural realities. Attempts to resist adjustment do not eliminate it. They redistribute it. Pressure is pushed forward. Stress is deferred. Imbalances grow. This is why intervention at this stage is dangerous. Not because it fails immediately, but because it distorts timing. When systems are allowed to adjust gradually, losses are absorbed over time. When adjustment is delayed, losses concentrate. History is clear on this. Delayed adjustment never reduces cost. It increases it. The reason is simple. Imbalances grow faster than resilience. Every period of artificial stability encourages exposure, encourages leverage, encourages assumption-based positioning. This widens the gap between structure and pricing. The wider that gap becomes, the less room there is for error. Eventually, adjustment resumes, but under worse conditions. Another reason this process cannot be stopped is credibility. Policy credibility is finite. It depends on consistency, on predictability, on alignment between words and outcomes. When policy attempts to support markets while inflation remains elevated, credibility erodes. Markets begin to doubt signals. Forward guidance loses power. Expectations drift. Once credibility weakens, intervention becomes less effective. More action produces less impact. More communication produces less confidence. This is the point many systems fail to recognize. Policy is not just a tool. It is a belief system. When belief erodes, tools lose force. Another constraint is political tolerance. Extended intervention has distributional effects. It benefits asset holders. It penalizes savers. It increases inequality perceptions. These effects accumulate. Eventually, intervention becomes politically costly. This limits duration, scale, and flexibility. Markets sense this, not explicitly, structurally. They adjust behavior. They reduce reliance. They shorten horizons. This creates a feedback loop. The less markets believe intervention will persist, the more they self-adjust. The more they self-adjust, the less intervention can reverse behavior. This is why turning points often feel sudden, not because policy changed overnight, but because belief did. Another irreversible factor is system learning. Participants adapt. Risk managers tighten limits. Treasurers change funding strategies. Investors reassess duration exposure. These changes are sticky. Once risk is repriced internally, it is rarely re-expanded quickly. Fear fades faster than caution, but caution lasts longer than optimism. This creates asymmetry. Upside recovers slowly. Downside adjusts faster. This is not sentiment. It is institutional memory. Another reason adjustment cannot be reversed is time. Markets can absorb shocks. They struggle with prolonged pressure. Extended uncertainty wears down buffers, consumes flexibility, reduces optionality. Over time, even strong balance sheets weaken, not through collapse, through friction. Costs rise, returns compress, decisions slow. Eventually, something gives, not catastrophically, incrementally. An incremental change compounds. This is why the idea of a clean reset is misleading. There is no reset button. There is only transition. The system is moving from one operating regime to another. That transition involves losses. It involves repricing. It involves discomfort. Attempts to avoid these outcomes only shift them. This is the paradox of late cycle policy. The more aggressively stability is defended, the more fragile it becomes. True stability comes from alignment, not suppression. Alignment between pricing and risk, between leverage and liquidity, between expectations and capacity. That alignment is being rebuilt now, slowly, unevenly, without drama, but inevitably. In the final part, we will explain how this process is likely to end, not with collapse, but with acceptance, and what that means for behavior going forward. Most people expect market cycles to end with an event, a crash, a capitulation, a moment everyone remembers. But forced adjustments rarely end that way. They end quietly, not because nothing happened, but because the most important changes already occurred beneath the surface. By the time the system reaches its new equilibrium, panic is gone, volatility has normalized, narratives have adjusted, the damage was done earlier, during the transition. This is the final misunderstanding. People think risk ends when fear peaks. In reality, risk ends when assumptions change, and assumptions are changing now, not suddenly, gradually. Participants no longer assume unlimited liquidity. They no longer assume suppressed volatility. They no longer assume policy backstops are unconditional. These shifts are subtle, but they are decisive. Markets eventually adapt to constraint. Leverage declines. Positioning becomes lighter. Time horizons shorten, not because of regulation, but because experience rewrites behavior. This is how cycles actually end, not with collapse, with realism. The final stage of adjustment is acceptance. Acceptance that returns will be lower, that volatility will be higher, that protection is conditional. This acceptance is not dramatic. It is boring, and that is why it is rarely recognized as an ending. Prices may still fluctuate, news will continue, debates will persist, but the structure stabilizes, risk becomes visible again. Liquidity is priced honestly, losses are absorbed without shock. This is not recovery in the emotional sense, it is normalization. Many people mistake this phase for stagnation. They say markets are going nowhere. They say conditions feel heavy. They say nothing works like it used to. They are right, because the system is no longer optimized for excess. It is optimized for survival. This is healthier, but less exciting. The most important takeaway is this. The danger was never collapse. The danger was misalignment. Misalignment between pricing and risk, between leverage and liquidity, between expectations and capacity. That misalignment is being corrected, slowly, reluctantly, but irreversibly. This is why trying to time a dramatic end is a mistake. There may be volatility, there may be stress, there may be episodes of disorder, but the core process is already underway. The system is adjusting, and once adjustment begins, it does not reverse, it completes. This does not mean pessimism, it means recalibration. Those who adapt early reduce fragility. Those who cling to old assumptions experience repeated frustration. Markets do not punish optimism, they punish rigidity. The next cycle will eventually emerge. It always does, but it will not resemble the last one. It will be built on different assumptions, different incentives, different constraints. Understanding this now is not about predicting prices. It is about understanding behavior, because behavior determines outcomes long before prices reflect them. The adjustment phase feels uncomfortable because it removes certainty. But certainty was always an illusion. What replaces it is realism. And realism is the foundation of resilience. The market is not crashing. It is learning. And learning is never smooth, but it is necessary.